Again, welcome everyone. Thank you so much for joining Mueller Financial Services and PKF Mueller for today's webinar, Fiduciary Best Practices. My name is Emily and I'm one of the marketing coordinators at PKF Mueller. And just a quick introduction of our two companies today. So Mueller Financial Services, which is a separate but related entity of PKF Mueller, is a financial advisory firm that has served clients for over 25 years, expanding its guidance from the regional to the national level through growth and acquisitions. We offer a broad range of services for corporations, business owners, executives, independent professionals, and high net worth individuals. Through strong ongoing education, sound investment strategies, and a strong sense of teamwork, we enter into a dynamic partnership with each client to best guide their financial investment and insurance planning needs. And PKF Mueller is an award-winning full-service CPA and business advisory firm serving clients domestically and internationally. Since its 1968 founding, the firm has significantly grown and currently serves clients from 4 offices in the Chicago area, an office in Sarasota, and an office in Philadelphia, employing more than 200 employees led by 23 partners. The firm provides a complete range of accounting, auditing, tax, consulting, and business advisory services. And for today's speakers, that includes Mueller Financial Services Shareholder and Wealth Advisor, Brent Kalka, who is a certified financial planner professional and an accredited investment fiduciary. And our PKF Mueller speakers are audit directors, Alex Krog, CPA, and James Hare III, M.A.S. and CPA. And all of our speakers today have lots of experience on the subject and are very excited to share their fiduciary and employee benefit plan audit knowledge with you. And before we officially start with the presentation this afternoon, I just want to go over a couple housekeeping items. If you do have any subject questions during the presentation, we will not actually be using the live question or chat box today, but hopefully as the presentation continues, your questions will be answered. But if not, you can most assuredly follow up with one of our awesome presenters after the webinar is over. And if you remember during registration, there was an option to ask a question ahead of time, and those will be addressed during our Q&A portion. So without further ado, I will turn things over to Brent Kalka, and Alex, I will give you the control of the mouse. So thank you.
Thank you, Emily. Appreciate that. Welcome, everyone. We do greatly appreciate your time spending with us today. We know it's valuable. Our goal is to provide you with information and some ideas to get you thinking about what your role is in managing a qualified retirement plan. So what is it that you've done up until this point? What, if anything, should you or could you be doing different to maybe improve on that process, or what you're doing as a fiduciary or part of that fiduciary team? So the learning objectives, we're going to talk about the plan sponsor as a fiduciary, what that means, the kind of organizing a fiduciary file, documenting things, and also identify some common issues found in the employee benefit plan from an audit perspective. So even if your plan is not one that gets audit, it's still really important to hear from these guys because of all that experience and what they have in dealing with audits. They know the strategies too that put you in the best place to, again, organize, manage, and be on top of things as a fiduciary to the plan. So again, we have a limited amount of time today. We want to stick to that time. So we go into some strategies. We're going to have a couple case examples, go through some organizational tips. Hopefully there's some Q&As that we can get and address for all of you, but we look forward to sharing some information and hopefully providing some value. So next slide, Alex. All right, so the plan sponsor as a fiduciary. So the qualified world is all under ERISA, which is a federal law, and that really sets the standards of conduct. So if you are a fiduciary, you need to be someone that's administering and managing this plan prudently. That comes up a lot in ERISA, and also everything is around the plan participant, right? So you need to be acting in the best interest of the participants and the beneficiaries that are part of that plan. So who is a fiduciary? Well, a fiduciary is someone that exercises discretion and control, really making decisions for that plan, whether it's investment related, administrative related, anything to do with that plan. So you could be a named fiduciary, which means in the plan document, the summary plan description, your name appears right there. So it's very clear that you are a named fiduciary with all the responsibilities that come with it. But you can also be a functional fiduciary, which means you are part of the either the person or part of the team that's making decisions around that plan. So we've run into a lot of people that are part of that investment committee or the day-to-day on the admin side helping with decisions that feel that they're not fiduciaries, only to find out that truly they are held to that standard of conduct and that they are responsible for all the decisions and all the, I guess, the conversations that they have around these plans, especially with participants. And that can even lead to the fact that we hear a lot that, they have people coming in, maybe you're an HR person, a CFO, an owner, and employees will often walk in and say, hey, what about this, right? You very much want to respond and just say, well, here's an answer, or maybe give some investment advice. Just know when you go down that road, and even if you don't, you are behaving as a fiduciary. So who else is a planned fiduciary? Is anyone that's really giving investment advice for a fee. So like us, Mueller Financial Services, we can be a consultant, we can be the actual named advisor to a 401k profit sharing cash balance plan. And in that case, we can function as in two different ways. There's what's called a 321 advisor and a 338 advisor. And this would be, it's important to know who you're partnered with. If you do have an advisor to your plan, what is their role? And real briefly, a 321 advisor is a team, an advisory team that will make recommendations, mostly around the investments, the investment process and monitoring, but it could be around other subjects as well. But we make recommendations and we put it to you, the plan sponsor, trustees, investment committee, and you ultimately have that decision making, right? So you make the final decision, yes, we're going to remove these investments on your recommendation, or we're going to hold and watch based on your recommendation. Where a 338 advisor is you're turning over discretion. So in this case, we would go through the same process and we would have our recommendations, we would share that, but we're pulling the trigger. We don't need approval, we don't need you to sign off as the plan sponsor. And some sponsors will take on the 338 or elect the 338 because they want to mitigate from a fiduciary risk standpoint as much as they can. So just be clear that when you are a fiduciary to the plan, you can never ever fully delegate your fiduciary responsibility. So even if you work with a 338 and you don't have to make decisions around investments, you still are held to a standard to monitor the 338 provider, right? And even the 321 provider. So at any level, there are many different steps that you can take to mitigate risk, but you can never fully get rid of that risk and that responsibility. And I want to point out too that, the industry has evolved a lot over the last decade, especially, but there are still advisors out there that cannot and do not take a fiduciary responsibility, right? So this could be an insurance salesperson that has a great relationship with the owner. They do a great job in the group benefits. They take over the plan, but they're doing it through as what's called a registered representative. So in that case, they truly cannot be a fiduciary, which we think is very important. We think when we are a co-fiduciary with you, we're held to those standards, right? If things go wrong, we're right there with you. So from our perspective, if you're going to offer a qualified plan, such an important benefit, having an advisory team that truly is a fiduciary as well is important. I do want to mention, it's not on here, something that's becoming even more important is what's called a 316 advisor. We don't function as one, but this would be a third-party administrator, and this is the compliance and admin side. And more, there's mistakes around payroll, getting things on time, and James and Alex can talk more about that and what they see out there. But it's more of a conversation to say, hey, in the admin, not the investments, but the admin side of this, how can I delegate more? How can I have someone else take on a fiduciary responsibility? So we're not going to get into that very much, but I want to throw it out there because we have clients that, quite honestly, they need a 316 because they're so busy and focused on growing the business or running the business that this important benefit sometimes isn't a priority, right? So this is really a good conversation to have as well. So looking at the standards of conduct that ERISA sets out for us, we have to act with care, skill, diligence, right? You have to diversify the investments that are inside the plan, which are minimum requirements, and most plans hit that no problem. Administrating the plan to the documents and the whatever is in place, what is written, and then evaluate the reasonableness of fees and what those charges are to the plan and the plan participants. And this is something that we do to help support the fiduciary responsibilities that you have. We have access to third-party benchmarking groups. We go to the marketplace and do requests for proposals. We're very much in tune with the marketplace and the service providers out there. So that's, again, something that may be very difficult for a plan sponsor to do, but your advisory team really should be all over that for you. So next slide, Alex. So other responsibilities as a fiduciary are select and monitor service providers, right? So a lot of times we'll see, well, I was given this one option, sounded good, so we implemented it. We don't think that's a sound plan that really works from a fiduciary standpoint. You really should go out to the market and consider more than just one service provider for whatever role that it is. It doesn't need to be a dozen, but let's say it's 3, right? So who's going to help you do that? Again, that's part of the role that we have. Going to the marketplace, providing options, being educated on that to make a selection. You have to maintain a plan document process, right? This is really taking notes, keeping notes. The reporting and disclosures, most of you would probably know, the record keepers these days are doing a very good job. They will provide these annual required disclosures, and some of them will even mail them or email them to your participants, or you may do that on your own, but that should be a pretty seamless process. And again, going back to that 316 service, this is something that falls under that, right? So if you really didn't want to worry about disclosures, didn't want to have to think about it and have someone else take care of all that for you so you can just be really on the strategy and decision-making side, that's where the 316 comes in. Of course, plan investments. As a fiduciary to the plan, you're going to be responsible for the investment process, monitoring, and how that works. And we're going to show an example or two of at least what our process is and kind of visually take you through that. So we do still run into companies out there that have no process in place, don't review the investments, and even years have gone by. So I'm sure there's some absolutely well-run benefit plans out there and some that need a lot of help, right? And everything in between. Avoiding and mitigating potential conflicts of interest. This is really important too as a fiduciary. And some of those will be things like banking arrangements. Personally, I have run into this before where a business, they're doing their banking business and say, well, we'll give you a break on your rate or your terms if you do your 401k with us. I mean, it's, in our opinion, clearly a conflict of interest. It happens, at least it has happened historically. There could be, you work with a record keeper that happens to manufacture products, right? So a big insurance company, they also are an investment company, and they're trying to say, hey, you should use our investments. And most of your options for your people are products where the company might be getting paid, obviously, because they manage those funds, but also other layers of fees that could be on there. So again, not necessarily that these things will be a conflict, but they need to be looked into to see if there is a conflict. Revenue sharing, there's still a lot of plans out there that have revenue sharing. How is that revenue sharing handled, right? Does it go to your service providers? Does it get put back to the plan participants? Is it used by the plan to reduce employer contributions or other fees and things in that manner? So those are important things to know to make sure that conflicts are avoided. And then the duty to be a prudent expert. And I don't like really reading slides so much, but this one is important. So the duty of prudence is usually satisfied if the fiduciaries, at the time a decision is made, considers all the facts and the circumstances that are relevant to that decision and act accordingly, right? So we don't need to make every decision be the right decision, but at the time when you have the facts in front of you or the information, you're getting recommendations, you know, what is leading you to that decision? Why did you make that decision? And then documenting that. And that's very important, right? We held on to this fund, and let's say there was a reason to hold on to an underperforming fund, and there could be reasons to do that. And then it really, really tanked. Well, why? At the time you made that decision, you know, can you come back and say, well, this decision's defendable? And that's what's important, right? It's not the outcome so much of the decision as to what was the process that you went through. So that, I think that's really important as we go through this. We can go to the next one, Alex. Oop, back to. Nope, you're going the wrong way, I believe. Still the wrong way.
Going great.
Still the wrong way.
Here we go.
Even one more. Thank you. And I don't know if we can blow this up or not. I'm going to talk through it, right? So it's important from the fact of, this is just a look at the advisor services, the schedule of services, right? So this relates to you as a fiduciary. How are you a prudent expert? And what most people choose to do is to hire someone, and what role do they play in helping you fulfill all those responsibilities as a fiduciary? So again, I'm sorry if this is, for me, it's very small, but I'll just walk through it really quick, not everything, but just to highlight how you can be supported as a fiduciary. So one, we're responsible for providing the investment policy statement, right? It's your document, but we have written policy statements that we provide. We review it together, it gets signed off. And again, a policy statement is not a requirement, but it's a best practice. And it can be really important. It's the blueprint to the whole investment management process. You've got the designated investments, which is really your holdings. What is going to be offered for all of the people that are inside the plan? So again, and these first 4 things I'm going through, this is what we as advisors take on a co-fiduciary responsibility, right? So we're right there. We're right next to you as far as the responsibility and the standards that you're held to monitor this. There's model allocation. So if you're going to have target date funds or asset allocation models, how are those built? How are they monitored? All of that process is part of that. And then the qualified default investments, or what's called a QDIA. That's important. So it really, you know, naming a QDIA is so important. It's so easy, but it gives you and mitigates some risk, some benefits there. If somebody's in the plan, they didn't choose an investment, what do they get defaulted to? And making the right choice there and making sure it's an acceptable choice really covers you from a fiduciary standpoint and a risk standpoint, but that's something that every plan should have in place. So some of the, on the bottom part of this, consulting services, this all wraps up to, again, what what you are held to as a fiduciary from admin, investments, education standpoint, and how do you go about fulfilling those obligations, right? So an audit file, which we'll go through a little bit here, like we can help people organize, keep things, we keep everything. So for our clients, all the reporting, everything, we have it stored, it's backed up by the server. So we are a backup to the plan sponsor. We assist fiduciaries in the whole process around selecting investments, monitoring, and also looking at service providers. So, I mean, there's hundreds and hundreds of service providers, record keepers, third-party administrators, advisors. So how do you wrap yourself around who is the right fit, right? So even if you're at a quality provider and you want to periodically check and say, hey, how do I know this plan we've been with? They're a giant in the industry. We've been with them for 15 years. Do you really know that they still are the best fit for the demographics and what your plan needs? That is something that you're responsible is to evaluate. So how do you evaluate those service providers? How do they stack up in the industry, right? So that's really important. We also help if it's deemed that we could do better, and we'll go through an example of that. We kind of run the show, right, as far as going to the industry, getting proposals, packaging it together, trying to make things as easy as possible. So again, from your perspective as a fiduciary, you can absorb information, get educated, and then get to a good decision, with you, if you're in this by yourself or with a team of people that represent the participants, what is going to help you understand that and make those good decisions. Again, around performance, investment managers, models, performance, we also with education. So what is the education plan that you have for your participants? We help coordinate group, and any advisor should, group education and even one-on-one education, being a resource for your people. So again, just highlighting some of those things that you come under your umbrella, but how you can delegate and get help in doing those things. So next slide, Alex. So just a little bit on research. The main thing about these slides is that people are becoming more and more aware that they're a fiduciary, right? In this one thing, 70% of them felt and knew that and understood they're a fiduciary, while 30% did not believe they were fiduciaries. So it's good that that's increasing. There's an awareness, but it's not so good that if 30% of plan sponsors don't see themselves as fiduciaries, that can be a concern, right? And especially that of those 30%, 46% of them have the primary responsibility over the plan, right? So again, the awareness is on the rise. Wherever you fit into this, we can just discuss further, but it is a very important responsibility. So next slide. This just continues that theme as the more someone's aware that they're a fiduciary, the more engaged, right? The more communication there tends to be, the more confidence there is on the processes, right? So in this slide, again, there's a lot going on, but the gray bar is saying, hey, these are the people that are aware. The blue bars are those that aren't aware. I think the real theme here is when you are conscious of it, it's important to you, the plan is going to be managed better. Next slide. And this really continues on that theme, that awareness, being engaged, especially with proactive philosophy, right? What's new in the industry? What other strategies can make sense for us by having at least that annual, a real big comprehensive review every year? You should be considering legislative changes, what's going on in the platform, your service providers, changes, technology. Things are always going to change, right? And hopefully for the better, but keeping your eye on that is really important. So,
Hey Brent, can you touch base real quick on, hey, so you're named fiduciary of the plan. What difference does it make to me? Because hey, I'm a fiduciary, and I'm not saying anybody would ever do this, but it's like, well, if I don't do very well, maybe somebody else will take the responsibility or something like that, and I can just kind of wash my hands of it. So can you just cover real quick, like why it's important to know if you're a fiduciary and kind of your personal potential responsibility?
Yeah, I think you just ended that with personal responsibility, right? I mean, at the end of the day, how realistic it is and how far it will go, who knows? It certainly has for some people, but how most people manage a plan, they probably don't make such big mistakes or fraud and stuff like that. But at the end of the day, if you're a fiduciary, you have personal liability, right? So if the plan needs to be made whole financially for whatever those circumstances are, it could come back to you personally. So that's because you are responsible and held to that standard. You can do things like getting fiduciary liability coverage through your business insurance provider, which we would strongly recommend. It's not expensive, just like some of the other insurances that you would normally get. But that is crucial. And when people get to a point where they're like, oh, so I could be held personally, my net worth, my assets, yes, whether how realistic that is, we haven't seen it gone that far, but we've certainly seen mistakes. But yeah, it usually puts people on edge, especially if they're not a business owner, right? So you're employed, you're doing your job, you're doing a good job, you wear many different hats, and all of a sudden you realize, wait a minute, something goes wrong, someone else makes a decision, I'm not even aware of it, but it comes back and I'm part of this because I'm acting, either I'm a named fiduciary or I'm functioning as a fiduciary, because yes, sometimes there's multiple people doing multiple things. So good point, thank you. I think this next slide here is really, as a fiduciary, you either, if you can't, I guess from an expert standpoint, get through all of this, all the evaluation that could happen, you can hire someone, right? So this is really highlighting for us an assessment and review that we do, and this is going to lead to an example, right? So the purpose is really to find out, how is this plan managed? How successful is it? Are there holes in the armor of what's going on? The process really is, we gather information, we tear down the plan, we build it back up, talk to the sponsor. Here's all the good, here's what might not be so good, just so you're aware, right? And if you get to the next slide, it really, all the things that you need to touch on as a fiduciary: plan design, fiduciary governance, administration, fees, expenses, investments, your service providers, education, right? These are all things that are part of a real assessment to a plan. And really, as advisors, at least for us, and you'll see in a sample agenda, we cover these things all the time, every year with clients. So behind the scenes or up front with the clients, this is, even though we're not responsible for all these areas, we just kind of pick it up and feel that this is part of what we need to do as an advisor. So next slide. So quickly, hopefully quickly, we'll go through an example, right? So we did this assessment process with a local company. I think in this case, it was a good sized company with almost 5 million in assets, with a very large provider. So this is an example, just again, because I don't know visually how easy it is for you to see things. And just know in our financial services industry, almost everything we do is very busy. And that's just how it is. And there's a lot of disclosures everywhere, but we seem to make everything very busy. But in this case, when we walked into this client, they had 31 investments, and we do things in our investment process through a third-party platform called FI360, very much fiduciary related, right? So the point is, you have to have a process. Your process does not have to be perfect. You just need to understand what is the process for understanding the investments, and that investment policy statement should point out, how do you monitor, when do you replace things, what's in it, what's not available to be in it. So in this case, we looked at this plan, and again, we weren't the advisor, just outside looking in. They were built on revenue sharing, right? So right away we knew that with the revenue sharing, they didn't have open architecture, meaning they didn't have access to every possible investment out there, which means the process, in our opinion, doesn't work as well as it should when you have access to everything. So that way investments don't matter, because service providers in that case, they pick investments and make what's available that is going to create enough revenue to pay them, to pay the advisor, maybe pay other plan expenses, right? Where our philosophy is much more clean shares. We don't want revenue sharing if possible. Be very transparent. So in this case, nothing was transparent. All the providers are getting paid through the extra expenses that's wrapped around the investments. And if you see the colors, the process is very visual, where green is good, red is bad, yellow is concerning, orange is concerning, 0 is the best score, 100 is the worst score, right? So again, in our process, there's 11 sets of criteria that give a score. And again, doesn't matter if it's not, those are the perfect 11 data sets. It's just that there's a process that continues to work for the client's benefit and the fiduciary's responsibility to understand that. If you can go to the next one. And you can see when we put our criteria through this client, and we see everything's on a watch list for multiple reasons. We see red, we see yellow, and there's some deep green, so we know that's good. But if you go to the next one, Alex, and then the next one, you can see here, this is part of our process. And again, you want everything in the lower left quadrant, and you can see here that there's investments kind of all over the place. But this is the things that we can bring back and help a fiduciary understand this and say, hey, this is where you're at. This is the process that got there. Now, what are your options, right? So that is fulfilling your responsibility. Next slide. I'm not going to go through all these. We can just kind of flip through them. And this one, no, go back one. Sorry about that, Alex. The point is there's a lot of information there. The process is solid. It's documented in your fiduciary file once, twice, 4 times a year, whatever the needs are for the plan. And again, here, that same client, I'm just going to point out something here because what happens a lot is people might be at a provider and feel that everything is in good order, right? So I'm in this case, this client happened to be with ADP, very huge payroll company, HR, 401k. And it was very clear they didn't want to leave ADP because they just got to ADP, right? So we came in, and once we went through the investment side of it, we started working with ADP to negotiate what else could they be on. So in this case, this client, they did not have an advisor with them. They were direct with ADP, and we'll see that with ADP, Paychex, Fidelity. The assumption was, well, isn't ADP acting on our behalf, giving us the investment lineup? No, they're not. They're not going to be a fiduciary on the admin or the investment side. Either is Fidelity, either is Paychex in almost all circumstances, and that'll be clear in the service agreements if those are reviewed. So we came back here, and at the end of the day, in this case, and again, I don't know if you can see it or not, but in the lower part of this, when it came to the expenses of the plan, we were able to, by getting to a mid-market platform through ADP, changing the investment lineup, we were able to knock about $10,000 a year in annual expenses for the mutual funds that were in there. So really that's, we think in 6-year terms, that's about $60,000 in savings for these participants over the next 6 years. Now, ADP was collecting about 17, and they told us it could have been as much as 22,000 for their fees. But when we renegotiated with them, the second column in this, and again, the whole purpose of this is to give you, the fiduciary, the information, right? So we do the work. Here's where you're at. Here's where you could be, and so forth. So in this case, even though ADP was collecting $17,000 to $22,000, all they required was $9,600. So right away, that's like $7,400 a year that was above their required to do their role in this, that if we weren't involved talking and helping the fiduciary client out, there's no way they would know. They're running a very good business, a successful business. They wouldn't know these things. So the value there is digging into this. So right there, you've got $60,000 and somewhere like $45,000 over a 6-year period, over $100,000 in savings to the plan participants for us going through the process. Now, of course, you know, and it's highlighted in there, they chose to hire us, engage us as the advisor. So, right, we stripped out a lot of expenses and we added an expense, and that's us. So obviously at that point, they saw the value. They did not want to be a fiduciary, and there was 3 people without someone being there with them. So at the end of the day, to them, it made sense to hire an advisor, and those expenses, those fees are much better to be put into that and give a better experience for their people, and also we're available for education and one-on-one conversations with their people. So just a case example there. We can move on. And next one, we can skip this one. Disclosures we can skip. So this is just another example. And again, that the purpose is whether, you know, us, of course, we think we're very good at what we do. There's a lot of good advisors. But if you're engaged with an advisor, these are the sort of things that they should be helping, he or she should help you with. This is another case of a client of ours. We were with Empower for quite a long time. Overall, kind of happy, but we went to them to renegotiate. But doing our job, and we believe this, it's not just about can we do better with your current providers, what about other providers? So we went to a couple other providers on behalf of the client, went to July and T Rowe. And again, there's a lot of noise on this, but that's part of just being transparent and putting everything where it needs to be for their fiduciary file, right? So for your file, it's all in there. So next page, Alex. This is really just showing at the bottom line that going to another provider and doing the right fiduciary move, which was periodically you should look at your providers, go to the marketplace, go through this process. We're projecting that we already moved this plan from one to the other, that over the next 6 years, we'll save the participants about $47,000 in fees and expenses. And that is obviously going to stay in people's pockets. It's going to grow over time and hopefully help people for retirement readiness. So again, these are things you're responsible for. How could you go through the processes and how can you get to this? And we've also gone through this process and ended up that you're in a great position. There's not much we can do. Yeah, your fees and expenses are in line. Everything is good. So that happens as well. Next slide, and then next slide. So fiduciary file, and I'm going to try to roll through this pretty quick because taking up too much time here, Cyril. So I apologize for that to Alex and James. But maintaining a file, we really recommend you do this electronically. You have it on the server, so things are backed up. We can help you with that. We keep things, but all the you know, your IRS compliance testing, insurance related, service agreements, meeting minutes, you know, all these things that make sense. Next file or next slide. This is just an example, you know, how you can organize things, right? There's administration, reporting and disclosures. You got investment related documents. You have your service providers. So this is just meant to say, hey, your legal plan documents can fall under this folder online, your regulatory requirements, testing, committee meetings, your fee disclosures. You know, on the investment side, we went through the monitoring, right? Investment change notices, committee meeting, again, executed investment statements or policy statements and provider stuff. So next slide. So to point out on this, we highlighted executed. So one thing we see a lot is there's probably executed documents somewhere, but it usually isn't with the plan sponsor. So, and I don't know, James and Alex, if you want to chime in at this point, when you go and through your process as an auditor, does it ever happen where they don't either have them or they don't have something that's signed?
Yeah, so one of the first things we ask for on every audit engagement, besides the engagement letter, of course, is the plan document and the signed executed adoption agreement. And maybe 40, 50% of the time, it is not signed and they don't have a copy of the signed version. So they have to reach back out to their TPA and try to get a copy of that.
And usually that takes probably
a little bit of time.
days, if not weeks, because you're counting on multiple people, right, to react. And oh yeah, I'll get to it. Yeah, understood.
Yeah.
So next slide. And again, I think what's here, the important theme is almost anything related should be in a file somewhere related to the plan. But record keepers these days, usually, especially if you bundle, if you're record keeping, the website, the transactions, and the third-party administrator is the same provider, you'll have a portal, right? And a lot of times they'll keep things there. So there is a backup usually. It's probably a good idea to download that stuff and have everything there, and you guys can talk about best practices around that. It makes sense though that it's on your server, everything's backed up there. It's nice to know that your service providers might have it too, but what if someone's not available? What if people don't respond to you? And third-party administrator, record keeper, plan advisor, these could all be separate entities that have their own service provider and service agreements. And these are important because as a fiduciary, you're required to review and understand those. Do you need to remember everything? No, but they should be something on an annual basis. You review those fees, you understand the fees and what services do or do not come along with them. So next slide. Again, other parts of your fiduciary file is all the disclosures that go out, all the notices that go out. Again, under that administration folder that you can have, that's important to have all that there. Next slide. Again, we mentioned an investment policy statement, and that's really the best practice. It's not a requirement, but maybe Alex or James can chime in. If you have a client that's getting audited, is it beneficial to have a policy statement that you can hand over to that auditor right in the beginning?
Yeah, I mean, technically, I don't think to your point, there's not a requirement for it. If you have it, it's obviously wonderful. We try to look out for as much as possible that people are fulfilling their fiduciary duties. So basically what we've talked about for the last little bit here. So if they have that, it's like, okay, these guys probably know what's going on. And if they don't have a whole bunch of information to give us, they're probably pretty hands-off with their plan, and would, potentially be open to more errors and things like that just because they're not as involved.
Very good. Last thing on here, meeting minutes. Again, you should be, as a fiduciary, you or your team should be taking notes. Your advisory, you could definitely have an agreement, and the understanding that your advisory team is also taking notes and providing those to you, right? So that is important to keep in the file. Next slide. So anything to do with this, Alex, we're going to skip through because we went through some examples. It's just more about that process and how you might work with an advisor to take you through a process. And this really quick is just a sample agenda. So if you do a more comprehensive review as a fiduciary to the plan, you should be covering things like the administration and operations of the plan, the compliance, fiduciary governance, fees, investments, education, and action items. This is an example of how we have our agenda set up. So even if we're not responsible for all these things, we want to address them, a minimum on an annual basis, and some things are talked about perhaps another couple times during the year.
All right, and now everybody's super excited to talk about getting audited, I'm sure. Everybody's favorite part of any year is when the auditors come in and start making you do stuff that's not part of your job. So we're going to talk about some different things that are some common issues that we've personally been finding in our benefit plan audits over the last 5 years, which have slowly escalated as companies continue to get bigger and we work on more plans, we see more stuff. So In case you weren't aware, the benefit plan audit requirement is once you're over 120 employees that are eligible to participate in the plan, you have to get an audit that needs to be attached to your Form 5500. So until you're over 120, so if once you hit 121 and over, at the beginning of the plan year, that's what triggers the audit. So you'll go from a short form filing to a large form 5500 filing, and then you'll need to attach an audit to it. So that's where we come in and can help you out with that. So the plan sponsor is generally is responsible for all the information, even though a record keeper is generally, keeping track of everything, and there's a certification of the investments and things like that. We generally just get access to the third-party website, and people say go for it. But in reality, you guys on the call are the ones that are responsible for that information, at least reviewing it and kind of knowing what's in it. So definitely important to designate a person to coordinate all that information and just kind of be aware of what's going on with it. So some different common issues that we've been finding that we wanted to cover here at the end is just covering some late deposit issues with contributions to the plan. So once you withhold hold dollar amounts, kind of what are rules around that. Talk about plan document and just why it's important. Employee contributions versus elections, and distributions and forfeitures and things like that are kind of the most common areas that we find errors or issues in.
Yeah, so I'll kick it off with late deposits. Thank you, Alex. There's a reason we listed this one as first. Every year, this is the hottest of topics at the AICPA Benefit Plan Conference and at the Illinois CPA Society Benefit Plan Conference as well. I think me and Alex have been going to those last 7 or 8 years, and this is always the first thing they talk about. The reason being, well, a couple reasons. Number one, it seems to be the most common issue we find in our benefit plan audits. Number two is because the IRS doesn't make it very clear. So the rule for late deposits, and for those wondering, late deposits would be the employees' 401k withholdings, and when they are remitted, when they're withheld from the company's account and remitted into the 401k account. So the IRS, I believe sometime in the 80s, came out and said that the plan sponsor needs to remit the employee deferrals as soon as administratively possible, or within the 15th day of the following month. So then plans came back and said, okay, we can remit it on the 15th day of the following month and we'll be fine. And then the IRS said, well, no, that's just kind of the max. We want you to do it as soon as possible. So not very clear, right? So there is a safe harbor rule for small plans, and small plans would be those plans that have 100 participants or less. And the safe harbor rule for them is that you need to remit by the 7th business day of essentially the check date. For large plans, the fact is that the DOL wants it done as soon as administratively feasible, which again is that check date. What we look for as auditors is usually that there is some consistency and that it's consistently good. So if your check date is, the second or every other Friday and the funds are remitted that following Monday, there's a 1 business day lag time, we think that's good. If you're doing it 1 business day every single time, and then your payroll clerk goes on a 2-week trip to the Bahamas and it's not remitted for 2 more weeks, technically that would be considered late, which brings us to tip number 1 here. In order to not have this issue, it's good to always have a backup plan. So smaller organizations, even ones that meet the 100-person criteria to be a large plan and have an audit done, maybe they have a smaller accounting department, only 1 or 2 people handling payroll. When somebody goes on vacation, they don't have a backup plan. So work a backup person into your control process to make sure that that does not happen. Because when it does happen, it takes your time. What happens when there's late remittances, we recommend that companies work with the DOL through the voluntary fiduciary correction program, and you'll fill out a form, you'll figure out the total amount of the late remittances, and then they'll ask you to pay lost earnings into the plan as well. as well as an excise tax. So this is very important. It's very common, so that you don't have to commit that extra time and cost you the extra money. Make sure you are staying on top of this. So non-compliance with the plan documents, another very common issue. You know, we were talking about the plan document and the adoption agreement earlier. This is kind of, I mean, it is the governing doctrine of every single 401k plan. This is the document that's been reviewed by the IRS. The IRS said, yep, it's good to be qualified as a 401k plan. So if you're not operating in accordance with that document, you could have your 401k plan revoked, essentially. So some of the typical issues we identify is that within each adoption agreement, there is certain age requirements or service requirements. Typically, we'll see you need to be 18 years of age or 21 years of age to participate, or you need to have a month of service or 1 full year of service to participate. Sometimes these rules are ignored and individuals will be allowed into the plan before they should be. Another big area is ineligible classes. So sometimes employees are covered by collectively bargained agreements. They're seasonal employees, they're interns, and the adoption agreement will specify that they are not allowed to participate. So you need to make sure that those individuals are being excluded. Enrolling participants too early or too late, again, in the adoption agreement, it should specify once an employee becomes eligible, when can they then begin participating. Sometimes it will be as soon as they become eligible. Sometimes it will be the first day of the next month. So be aware of that. This is something I seem to find more often than not, because it'll just be set up to automatically, as soon as they're eligible, get them enrolled, when the adoption agreement says technically that's not the case. And then auto enrollments. This will be missed sometimes. The plan adoption agreement will say once they become eligible, they should be automatically enrolled into the plan unless they elect otherwise. And then another piece with the auto enroll, sometimes they have automatic increases each year. We're on their 1 year anniversary. It will say, all right, you're going to bump this up 1% or 2% up until 6%. And this is overlooked a lot of the times as well, because it's not set up automatically in the system. And another item we're finding, as more plans are working with the Fidelities, the Voyas out there, everything's done online, so there's very little paperwork anymore. So when these individuals reach eligibility, usually they're made aware that they can participate in the plan, but it's not always documented. So people will become eligible to participate and elect not to, but if there's no documentation of that, that could cause you trouble down the line. So if you don't have auto enroll, or I guess regardless of if you have auto enroll or not, if somebody elects not to participate, be sure to have some evidence of that on record, just to protect yourself from anything that could happen in the future.
All right, we'll start this next slide with the tip, which would seem relatively common sense, right? Make sure your payroll processing person, the 401k, understands compensation codes. That would seem like a good thing, especially if you're trying to figure out what needs to be remitted into the plan or not. So often the definition of compensation is not applied correctly. So, it's always important to just, I would say every 6 months or something, like just review the adoption agreement, review the summary plan description, make sure that you're refreshing yourself on, hey, are we deferring on everything that should be deferred on? Are we excluding everything from compensation that we should be? So whether it's post-severance compensation, fringe benefits, bonuses, commissions, potential differential wages with shift changes, things like that. Whatever's in the plan document, just make sure that that's what you're deferring. So we see it constantly, and especially for one-off pay codes that are being used. So it's like, hey, we're gonna issue a manual check or something for somebody. Those are the ones that we constantly find the errors on because we're testing over the course of the entire year. So that one-off is going to be captured in the year-end payroll, even though it's just kind of a one-off payroll. So super important to make sure that you're aware of, hey, what compensation should be included, what compensation should be excluded. And then when it comes to employee contributions and participant elections, yeah, those people that are changing their deferral rates like every other pay period are really hard to keep up with, but it's still really important that you're looking at feedback files or whatever platform you're working with to make sure that those changes are making it into the payroll system, and then that the deferrals are happening with the participants' elections as soon as possible. And then also, very important to note, hey, if they're electing Roth, if it's available in your plan, some plans it's not, but make sure that if it's supposed to be pre-tax or post-tax deferrals, that difference is properly being calculated. More common errors, so contributions not using the correct matching formula, or a lot of people, well, not a lot, but some will have like a separate match calculation that they'll do in Excel, and a formula could get screwed up when they're calculating a period's matching contributions. For employer contributions, some companies have safe harbor, some are discretionary, and so those might be labeled with the wrong things when they're sent to your record keeper for processing. So very important to note the different types of employer comps there, and then just making sure that anybody who's going over the compensation limit, that those calculations are being looked at. So back to you, James.
Thanks. Yeah, one of the things I forgot to mention earlier, every plan has a plan document, an adoption agreement, and typically a summary plan description. And I've found sometimes that the summary plan description does not match up with what's in the adoption agreement. So it is nice because it's summarized, it usually gets straight to the point, whereas the adoption agreement, it can be difficult to find things unless you can use Control F in PDF. So double check that summary plan description sometimes. If you're really trying to figure something out, don't rely on that, refer to that adoption agreement. So distributions, within those documents, the adoption agreement will specify certain, sorry, somebody's knocking on my door right now. It'll specify what types of distributions can be taken, whether or not loans are allowed by the plan. The adoption agreement will then also specify what the vesting schedule is, which lead into your forfeiture calculations on distributions. So, oftentimes it'll be a 3-year tiered schedule on vesting, where after 3 years they're 100% vested. We've seen some plans where they've converted over to a new TPA, and it's a rather manual process, and they exported into Excel, and somebody made some changes, and it resulted in John Smith having whoever else's vesting number put next to their name, and it resulted in certain people taking distributions and getting less money than what they should have, and others getting more money than what they should have. So if something like that happens that's unusual, be sure to double check those vesting percentages, because it can be a pretty big error. So action steps for plan sponsors: be aware of your fiduciary responsibilities. I think Brent did a great job of walking you through some of what those responsibilities are earlier in the presentation. Gather and organize documents and records. We provided some examples of that. Not only will your auditors ask for it, but if the plan were to ever be reviewed by the Department of Labor, you're definitely going to want to have those on hand. Observe operational compliance, set up internal controls. I think that's just 2 key pieces as your fiduciary responsibilities to make sure you keep your eye on that, to make sure that the plan is operating smoothly.
Yeah, thanks guys. Great information. Just to continue on some action steps, evaluate your administrative and investment processes, right? Whether you do that on your own or through your advisory team, or have a consultant come in if need be, but get some help. I mean, there's so many layers to this, to managing a plan and the responsibilities. Benchmark your plan, especially if you've been with a provider for a long time. Regardless, every 3 or so years, you should really dive in and do even a mini request for proposal process, benchmarking process. That's a good standard. And liability insurance, you know, are you covered, right? If you haven't had that discussion, your business insurance provider, go to them and talk about fiduciary liability insurance.
Yeah, I don't think we have time for questions as we're right up against 1 o'clock. So we'll make sure to reach out for anybody that did have questions. We'll reach out to you individually to make sure that yours get answered. Otherwise, here we are again. If you do have any questions, feel free to reach out to us. We're happy to help anytime. And if we don't know the answer, we will find somebody who does know the answer. But we like to think we know what's going on. And then here is our magical disclosures slide. So thanks for hopping on, everybody. Hopefully we informed and entertained appropriately. And Brent, you have anything else?
No, just that. I mean, I know we went right up to the bell here, so we appreciate everyone's time. Hopefully you got 1 or 2 things away from this, because there's so much information in any one of these webinars typically. If 1 or 2 things make a difference, that's great. And I don't know, Emily, from a standpoint, if there are some questions, you know, we can certainly stick around for a couple minutes, and those that need to go, they drop off. And if anyone, you know, if there's a few that you want to throw, we can put those out there and try to address a couple before we sign off.
Yeah, thanks, Brent, Alex, and James. You had really great insight today, and thank you so much for everyone who joined us today and stuck around for the last couple minutes here. We really appreciate it. I don't think we're going to go through any extra questions. We'll just go through the questions that were asked during registration, and I'll provide those to you. And like Alex mentioned, the team will reach out with those answers for you. And I just wanted to quickly touch on CPE for those who indicated they needed it during registration. If you look at the handout section in your control panel, a sign-in sheet and class evaluation sheet have been provided for you. So please fill those out and send them to the email that is provided in those, as well as if you saw in the chat box, there's another email for our PKF Mueller Services email. So that's pkfmuellerservices@pkfmueller.com. And I will also follow up with all of those who indicated CPE. So do not worry about getting that set up for you. And then there are other helpful handouts in that section as well. So some of those were provided in the presentation today, and some of the other ones are regarding just in general who Mueller Financial Services and PKF Mueller are. And that's all that I have. So thanks again for joining us today, and we hope to see you in some of our future webinars.
Thank you, everybody.
Thank you, everyone.